All right. Some of you on Instagram are giving me quite a few compliments. I appreciate that from all of you guys. But head over to YouTube and leave them there so that you can be a part of the conversation. Don't want you to miss out. Looks like we've got a couple people here on YouTube. Kyle's not going to be joining me today. So unfortunately, this won't go as smooth as it usually does when I have some technical help. But nevertheless, we're still going to have a good show. Christian was going to be joining me as well, but his internet went out. So, I think we might have him. Christian, can you hear me? Christian, can you hear me? He doesn't hear me. We will work on that. Give us a little bit of patience here. All right, Instagram, this is your last call. Head over to youtube.com/David Green Real Estate. Join us there and tell your friends. This is your chance to ask me anything and learn about loan products that are new in the industry that you'll have access to, probably not forever. So you don't want to drag your feet on that and learn about what I'm buying. Christian, can you hear me yet? Christian is fighting through some technical difficulties with bad internet, so he may be back and forth. In the meantime, we will get it rolling, and I'll just stop to try to get Christian going. He's in Tennessee. I'm in Georgia. We're both in the mountains, but we're in different places, and unfortunately, internet is very spotty. When you're in the mountains, he's actually in the Smoky Mountains at a property that he and I bought together that's absolutely beautiful. If you guys want to rent one of my cabins, you're welcome to reach out to me and I can get you connected with the property management company. The one Christian's in has a private theater room, an indoor pool, lots of bedrooms, big private lot close to Gatlinburg, which is a great location there. That property's awesome. And then I am in the Blue Ridge area in Georgia looking at cabins up here. I looked at some waterfront property stuff on private ponds. I looked at some other properties that I've got some plans for if I can get them under contract. So it's been a good time. Ricardo Mendoza from San Francisco. Welcome. Okay, let's see here. I will start by answering your guys' question, and then we'll figure out how we can bring you into the actual room to ask questions. I'm going to ask that you guys keep your questions to the topic at hand. So today we're going to be talking about, assuming Christian can get here. If Christian can't, we might move.
I think I am. Can you hear me?
Hey, we can hear you. What's up, brother?
All right. We're in Tennessee Mountain Internet here, so let's hope this holds up.
And I didn't tell you this, but for this entire episode, you and I are going to talk with accents from Tennessee and Georgia.
I'm going to let you take that one single-handedly, David.
No, brother, you got to join me. It's going to be all right. It's actually going to be more than all right. It'll be a little slower than I'm used to talking, but that we're going to have to make people guess where we are when we record these based on the accent that we are giving as we do it. So normally what we do is we give people the opportunity to text in with their question, and then Kyle screens them. And then once we know what your question is, we put you on here. So I'm going to have to ask you, since we've got Christian, please don't use this episode to throw random questions about the burr that you're stuck on or how to build your core 4 or any of the other stuff you're dealing with. We're actually talking about loan products today. If your question about loans or something we're describing is relevant to an issue you're having, of course, we'll help you with it. But we don't want this episode to get out of hand with stuff that isn't relevant to the topic. So I'm going to share with you guys the link to get your question, or to get brought in to ask a question. And then I'm going to pick you guys. And as long as you ask a good question, we'll answer it. If you ask something inappropriate or not related to the topic at hand, we will move on and ask somebody else. Christian, before we do, let's monologue for a little bit here. So first off, I was telling people about the cabin of ours that you're staying out there. How's it going?
Pretty good. I hope everybody wants a little tour here, but got sitting in kind of a cool living room here. Got a big kind of open concept kitchen. Got like some balconies and stairs upstairs. It's got 5 or 6 really big bedrooms. Honestly, each of the bedrooms could probably be 2 bedrooms. So it's an awesome spot. It's got an indoor pool, full wraparound patios, and the view's a little blocked right now. But we're gonna do some tree topping while we're here in a sustainable manner, of course. and hopefully open up those views a little bit. But I've been very, very impressed with it. This is my first time seeing the property, which is exciting.
That sounds crazy, but if you read Long Distance Investing, you'll realize it's not crazy. You actually can buy properties without seeing them. Doesn't mean you have to. Doesn't mean you're dumb if you do see a property. Just means it doesn't have to happen once you've learned what you're doing. It's not something that newbies should do. As I just said, I'm out here looking at cabins and I want to see them because I'm trying to come up with a plan for property. So I'd say in general, the more commercialized the product is, if you're buying a fourplex and there's not a whole lot you're going to do other than maybe improve it cosmetically, or you're buying like a commercial, I kind of want to say commercial residential, like a residential property that's more than 4 units, however we want to describe that, big multifamily. You don't really need to see those. If you're buying just a single family house that you're going to fix up and rent out, you don't always have to see that. If you're doing something a little bit more sensitive to the type of property it is, a short-term rental, a vacation home, a flip, something that you're going to be modifying the property quite a bit, you're probably better off to see those kind of properties. So
yeah, absolutely. And I think especially, I mean, David, you and I have been able to do this so successfully because of our boots on the ground too, right? I mean, your core 4 strategy. I mean, we have a really strong property manager out here, right? We have really, cleaners, maintenance people already lined up before we even bought the first one. We had a team implemented in place that we had confidence in, which allowed us to invest, with an added layer of security that we wouldn't have had otherwise. So can't forget about that. If you are going to buy sight unseen, make sure somebody sees it, right?
Yeah, that's a good way to put it. Like, you don't have to see it, but somebody has to see it. So if you've read Long Distance Investing, you know that my system is that you need 4 people. We call them the core 4. You need a deal finder, which is usually an agent, a loan officer or a lender, a property manager, and a contractor. If you have those 4 pieces, you can put together a team in any single area. And usually once you get one of them, they can provide the other 3 or 2 of the other 3. And then between the 3 of them, you can get the 4th. So what I typically do is I start with the agent, because agents are usually the most connected. I find the agent in the area. They give me a referral to a property manager and a lender they may know. In this case, you guys already have a lender because Christian and I are here and we can do your loans. Now we can also help you find the agent. So now you've got the agent and the lender. You just have to find the property manager, and then one of them will have a contractor. And at some point, we'll have a property management company for you to use nationwide as well. So we're trying to solve that problem for everybody of how you find the core 4 so that you can make wise investments.
We're going to have to call it the Green 4 at one point here.
We got to make that rhyme though, right? Like I can call it the Green Team, but
there you go.
Now that conflicts with the David Green Team. So maybe I got to change the name of the real estate group so we can start calling the Green Team instead of the core 4.
Right.
That's funny. All right, Arthur Kovis, we're going to start with you. Click on the link that I sent you. It should be a StreamYard link. Let me make sure, put it up here. That link right there is what I want you guys to click on if you want to come in and ask us a question. And you can ask us about the loan products that we are using right now, specifically for investment properties. Now, I will say this. Christian called me yesterday like a good partner and gave me scary news. He's like, dude, you're buying too many houses. I don't know how long we're going to be able to use these loan products. So this isn't a panic moment for you guys. We're still able to get you loan products, but we have access right now to very awesome ones. Like normally you don't get stuff like this. And we've been able to pull this off. So if you're sitting on the fence, that should be enough to get you to pull the trigger. If you're not quite sure what to do, I told Christian, like, well, then I guess I better go on a buying spree and get as many of these things as I can before we don't have that loan product anymore. Because now the types of deals I can get are going to be much harder to find just because I will lose access to that product. So we want to tell you about that as well as a couple more. So Arthur, if you're still there, can you please click on that link and enter the studio? What else you guys got? I see Tanya Petty says hi from Central Kentucky. Same neighborhood as us. I believe Kentucky's close to Tennessee and Georgia. So hello there, Tanya. At least we know we're a lot closer than we are in California. We're both Christian where I live.
Very true. We do have a couple. I'm scrolling up. We do have a couple questions up at the top. Would love to rent one of your cabins. Love that, Shauna. Appreciate that. If you private message either me or David, both of us, I don't know if we're going to have this on our YouTube links or anything. But I'm Christian at the onebrokerage.com. David's got his. I don't know if you want to put your email around there, David. We would absolutely love to host one of our cabins for you guys. So reach out to us and we can get you a direct link booking. I do see Joe Raza in the.
So I'm going to bring in Joe and I'm going to see if you can start off his question. And then I'm going to see, since Kyle's not here, if I can figure out how to display the little banners on the bottom that he normally does. Joe,
Yeah,
welcome to the live. And let me just say, I love your haircut.
The natural one. Yeah.
Are you talking quiet because you don't want your wife to know that you're on YouTube learning about real estate?
No, my wife is an ex.
Okay. So were you just talking quiet because you have a quiet voice?
I kind of have, like a little bit cold going on. So
okay, good.
I don't want you to catch it. Yeah, my question was actually because I'm trying to write things down really quickly, and I missed those 4 key people because I'm just a rookie, even though I'm 53. I'm trying to learn as much as I can before I jump in. And you mentioned 4 people for like realtor and was it broker?
You're doing good so far. You got realtor, loan officer, loan broker. Yep.
Contractor.
Good.
And then there was a was it the manager?
That's the core 4 right there.
Okay, so I did it all by myself. I didn't have to waste time.
You didn't waste our time at all. You just realized that you got to believe in you, Joe. And we all got to see you come of age here. So tell me, what area are you thinking about buying in?
In short-term rental, but I'm trying to like figure out like what my product is going to be based on the short-term rental, like beach and ski kind of things.
Maybe. What's most important to you in the property?
Since I'm 53 and 50 going on 54, well, I'll be going on 55 hopefully too. I'm interested in something for me in the future. But I'm also wanting to rent out short term and provide for my family, but in the long term, some cozy place to retire in and kind of so I'm looking for something for myself actually in the long term, if that makes sense. So
you have to do it all in one shot. Like, do you have to get a property that's going to meet all those needs, or can you buy more than one?
I want to start out buying one and kind of scale from there, like you've taught, and I'm just overloaded with information, so I'm trying to.
Well, that's why I'm asking, because it's better if you don't try to get one property that's going to be a great investment and one that you're going to want to use yourself to vacation in and one that you're going to retire in, right? It's better if you can, over a period of time, accumulate a couple of them, and the same house that you use to retire in isn't going to be the one that you necessarily want to make the most money possible. It's very difficult when you try to have one property that meets all your needs. It's kind of like that stereotypical advice people give you where they say, don't marry somebody and then expect them to meet every single need you have. You still have to have friends. You still have to have other family members. You don't want to put all of your chips in one basket. I think I just probably combined 2 analogies there, didn't I? I think it's all of your eggs in one basket, and you don't want to put all your chips in one hand. And I said chips in one basket. I just Michael Scotted myself right there. I hope you know what I mean by that, Joe. We find you a property that would be a good investment property. You kind of get your feet wet with that. And then maybe on your next one or your third one, you find a property that you wouldn't mind using yourself to vacation in.
Right.
And after you've got a couple of them, well, then you could let those pay for the house that you want to retire.
Right. Exactly. And, and with my, 9-to-5 job, I'm, just eking out as many hours as I can, even on a Friday or on the weekend, just to learn as much as I can. And I just started this process, seeing you on YouTube. And so I really appreciate all the information you give us in your podcast.
Thanks, man. I don't want to put you on the spot, but did you want Chris and I to work through what some good options would be for you to get your first property, or do you just want to kind of take your time and figure that out for yourself?
I'm not in. Well, I would love that actually.
All right. So we just ask you a couple questions to get a feel for what price point you're at, and then find how comfortable you are with management or self-management, a couple things like that. And then we can narrow it down and give you some really good options. Would that be okay?
Yes.
All right. So what's a comfortable amount of money that you would feel okay putting down? That wouldn't be every single thing you have, but that you would know, hey, I can put this down. And if it didn't go as good as I thought in year 1, and it took a couple years, like in case it went wrong, you'd be okay.
So do you mean put down as
Down payment.
a down payment?
Yeah.
I mean, I'd say 100,000.
Okay, that's perfect. Now, are you okay with managing the property yourself, or would you rather have a property manager that did everything?
I am like you. Like, I would rather have somebody. I think I'm like you of the mindset. Yeah. I mean, I have somebody mow my lawn. I have somebody clean my house already. I want someone to manage my property. So that's what I'm looking at.
Christian's the same way. We both operate on a very similar wavelength.
If I were to manage it, I would find a way to screw it up. I'm telling you.
That's right. Okay, that's good. I'm assuming that you'd be okay if we recommended a property manager for you if we know one in the area or one that we use that you'd be okay with.
Yes, absolutely.
Okay. When it comes to your priority for the property, do you have a preference over obviously we want it to cash flow, we want it to grow. It's not like you're saying I don't care about one of these, but they're all weighted. There's markets that cash flow heavier, there's markets that grow faster, there's other markets that allow more creativity. When it comes to what you think is most important, would you say solid cash flow, a super high upside, like you want to try to get a home run with the property? Are you looking for a big construction project you can burr, long-term growth? What would you say is most important to you?
I'd say a property that's cash flowing, and one that provides value to the customer.
Good. So something, maybe a short-term rental where a family could go and have a vacation and make memories, and the kids will remember that cabin that they visited, that had some cool amenity that like they had a great time, and the parents got to feel like they did their job as parents and gave their kids a good vacation, something like that.
Yes, and I know a lot of people in St. Louis area go to Destin, Florida. I'm sure you know where that destination
Christian
is.
could tell you a lot about that.
Yeah, very clear.
And my ideal property, I guess, isn't really like an apartment style rental, but maybe I'm wrong on that. I'm thinking more out of the box, like a couple blocks from the beach, but that's also highly priced as well, I know. And so I'm kind of like envisioning that, but maybe that's a goal I can get to through a different, like, a 2-bedroom condo style. Like maybe I'm overlooking those opportunities.
Christian, what questions do you want to ask?
Yeah, I would say in terms of so David asked a lot of good questions for the initial like upfront questionnaire. Long-term wise, are you looking for something that's going to replace your W-2 income in terms of cash flow? Or are you looking for something that's going to be a cool property to inherit, maybe for a kid or a, I don't know who you have for inheritance, but a loved one, right? Or are you looking for something that's going to, cash flow enough where you can retire in a couple of years, right? What would be the most kind of biggest priority for you in that regard?
Definitely, I'm stuck in this 9-to-5 job. That's, I've been frustrated for many years, and I definitely don't want my boss listening to this, but I don't want to lose the job, but I also want to work for myself. I want to live for myself, right? A lot of us work for somebody else's success. And, the 401k is just not cutting it for me, where I'm, only technically 10, 11 years away from retirement, and I'm not comfortable whatsoever.
Let me give you a piece of advice here, Joe, about getting started, okay? And it's not going to be super tactical. It's kind of big picture. You've got the right idea. What I would ask of you is that you don't try to get all of your goals met with the same property. Let me give you an example of what I mean. Someone messaged me on Instagram the other day, and they said, hey, I have this duplex, and I've got a family there that is renting from me, and they're on hard times. What do you think about discounting people's rent so you can give them an affordable place to live, and you can do your job of being a good person by helping out this family by keeping your rent cheaper than the competition? And what I told her was a little surprising, but I believe it strongly. I think you are much better off to separate investments for the purpose of making money and doing charity work for the purpose of benevolence. You should not ever combine the two things. It rarely ever works well. What happens is you discount this family's rent and you want to pat yourself on the back and feel like you did a good job. and then they don't save the money the way you thought they would, or they live irresponsibly, or they don't take care of your property after you just gave them this steep discount on the rent, and then you get resentful. Then when you want to actually raise the rent, you can't because it's been kept low, and there's a lot of areas with rent control that limit how much of a percent you can raise that rent every year. So now when you want to go sell the property, you've had this person at discounted rents for 5 or 10 years. You want to now sell it and take your equity and go do something else after you feel good that you helped this family with keeping their rent low or whatever the case may be. And your property is worth 75% of what it should be worth because the person buying it has to inherit this tenant that they don't really want to give discounted rent to, and that they can't raise the rent on. And you try to do a good thing and you shot yourself in the foot. You would have been way better off to raise the rent and get fair market value and take the difference of what you were charging and give it to someone that you decided you wanted to help. Okay, so you can help people. I help people all the time. I'm not against it. What I've learned is that the way you help people makes a big difference. If you help them with your business, which is what an investment property is, it will often blow up in your face. So as you're thinking about, all right, I want a property that people can make memories in. I want a property that can also get me out of the job that I don't like. Those are two separate goals. Okay. It's like, I want to make friends and I want to get fit. If you can find a friend that works out, that's awesome. But if you try to find a friend that also works out that you can trust, you may be going through a lot of friends before you get that friend. Find people that work out with, and then find people you want to be friends with, and they don't have to be in the same group. So what I would say is the better that you can put yourself in a strong financial position, you focus on the investment element, you focus on building your cash flow, you focus on replacing your income, the more of a position of strength you'll be in to then go help the people in your life that you want to help. You kind of gotta, I don't want to say be selfish because you're not doing this at someone else's expense, but you have to prioritize your well-being before you can go help people. And when your well-being is in a good position, you can help everybody. That's when it's freaking awesome. But if you try to take your well-being and you give it to other people while you're trying to climb, you will never get out of that hole. You'll be 65, 70, 75 years old, still working, still wishing that you could go back 20 years and you could have got yourself out of that hole. You won't be able to help anybody.
Understood. Yeah.
All right, cool.
That's yes.
I'm glad we're on the same page. I'm glad everyone got to hear that because a lot of people are in this spot. They're like, I want financial freedom because I want to help people. But then they try to help people in getting financial freedom and they don't do either. They always have to help them. They always have to worry about themselves because they can't help anyone and they never got financial freedom. So with this being said, Christian, are there any markets that are kind of jumping out at you that would be a good place for Joe to get started?
Yeah, I think obviously the ones that, I mean, I'm biased because of where we've invested. I'm not sure if something local would be more attainable, or if Joe, if you're comfortable going to someplace like Destin, being further away from where you are, obviously a strong network of boots on the ground is vital in that regard. And you mentioned especially condos kind of being a little hesitant to them. I understand that. I don't invest in condos myself, but typically those are your lower price points. So if you're, I'm getting the sense a little bit that you're a little on the risk adverse side, which is probably why you've been able to obtain the wealth that you have through a W-2 job. You've been able to save up, have the 401k, all that stuff. So I would say with the first one, invest in something that's maybe on the lower end, but is a little more risk adverse. So that's maybe a short-term rental that may not have the numbers like this property that, I mean, David, I think we think Pinnacle will do $220K a year, something really good. But this is also a huge risk. If Airbnb regulations come on, or if we have a big shutdown on the property that it's in a fire hazard, we could make nothing, right? Whereas a condo in Florida, that may be something that, hey, you could always convert that to a long-term rental and rent it out for $3,000, $3,500, $4,000 a month. And your worst case scenario is still a really solid investment. You get the tax write-offs, you get the capital gain. I mean, you get the depreciation that you can write off, you get to write off your expenses. You're still getting less tax implications, which is a benefit. And you're still not at a huge risk of like a monumental loss, right? And obviously insuring the property correctly and all that. And then, hey, if that goes well, that's when you start that snowball effect, right? You start the burst strategy, you start these strategies that can grow 1 into 2 into 3. And then, if you focus on maybe buying one a year, right, for your next 4 years, like if you really dedicate yourself to that and, save, limit your expenses where you can otherwise, you can really start rolling those. And eventually in 5 years, you got 5 properties with $200,000 in equity each. And that sounds like a really far shot off now, but if you really plan, it's not that crazy. It's 50, 100K down, on a property. And then once that thing cash flows $2,000 a month, you take that extra 25,000 a year, roll it over again, maybe take some 401k distributions out. And now you're really talking, right? That's where I would absolutely recommend starting. I like the Florida market. I invest there. That was a long-winded answer, but that's what I would recommend, David.
What do you think about hearing that, Joe?
I think it's a great advice. A lot of my friends are saying, because we're kind of all thinking about the same thing here, and some of my friends have goals of just being new like me, saying that they want to get 10 properties next year, and I'm thinking, I mean, great if you want to, but I don't know if that's for me. That's a lot of risk, and just my gut feeling, I guess. I want to take it, just like you said, Christian, where kind of, especially at my age, right? I don't have a lot of time. So, well, I'm just saying 5 years from now, right? If I just have 5 properties, then the appreciation is greater than the renting, right?
100%. That's what a lot of people forget, right? With real estate, you got 3 or 4 different methods of income as opposed to your 401k that basically the stocks have to go up, right? That's the only way you're making money. The stocks have to increase, but with real estate, you got your appreciation, your cash flow, your tax savings you're getting, your pay down on your loan, right? Your leverage that you can utilize, your refinance in the future where you can lower your interest rate. And all of those, once you start stacking cards in your favor, all of a sudden you got 4 or 5 different methods of income that you didn't have on your 401k. Right. And you build up 1, 2, 3, 4 properties all doing the same thing. And eventually you got quite the inheritance to pass down. Right. You got quite the retirement supplement that you've built to supplement your 401k or your pension or wherever you're getting. Right.
$20,000 in education loans.
Yeah. I mean, that's a whole different conversation. But yeah, that's
literally that's why I'm doing this too, is, like you said, David, it's, we're trying to help other people all the time. We're just helpers. We just try to help everybody regardless, but I haven't helped myself in anything, really. I haven't. And so I'm starting this to help me.
That's the point.
Absolutely.
And you got to remember that. And you can't feel guilty about that. You got to protect what you've earned. You got to invest it well. And when you've done that, you'll have plenty left over to help everybody else with. And you'll be able to help them with more than money, because you will learn things on this journey, and that's even more important to pass down. If you'll notice, when people ask me questions, they're always looking for the fast answer. David, what city should I buy in? What property should I pick? Like, what's the quick way to find the best deal? I just want to go buy it and be done. And I always turn around and say, let's deep dive and pick apart what you're trying to do and why it works and understand the principles. The few people that have the wisdom to understand, if I grab the fundamentals and the principles, all the details will work out, they build massive wealth. The people that are looking for the quick fix, the short answer, just tell me what I need to do so I can jump on and do something else in life, they never actually get either one. So I don't think you need to buy 10 houses next year. Who cares? Buy 1 house. If you like it, buy 2 the next year. If you like it, buy 4 the next year. And then if you love it, go buy 10 every year after that. Your friends might buy 10 houses. And I tell you what, if you buy 10 short-term rentals in 1 year, you're probably going to hate what happened. It's going to be like smoking a pack of cigarettes the first time you ever did it. You're going to never want to buy one again, right? Like, I just bought 10 right now, and I'm already like, why am I doing this? This is so stupid. But like, I'm addicted, right? I'm going to go and I'm going to do more. I'm like this is a terrible analogy. I'm like a lifelong smoker, right? But yeah, real estate's not like smoking. I shouldn't have taken it that direction. I think you know what I mean. Like, don't worry about what they're doing. And the other thing is, don't get hung up in the numbers, like how many doors you bought or how many properties you bought. They can say they're going to buy 10 houses. I doubt your friends have $2 million they're going to go deploy. They're probably not buying the best properties ever if they're buying 10 of them. It's going to push them into an area that you don't want to be in. It's not going to have a lot of growth. They're buying themselves a job, and it's probably a job they don't like. So like, there's very few people we know that are on a YouTube live like this or that talk about real estate with their friends that are going to buy 10 houses the next year. There's a handful of people that do that, and they didn't do it right off the bat. Just like you don't go in the gym and try to bench press 400 pounds your first time in there. You start and you build up. And if you love working out at the gym, okay, you get to the point you can bench press 400 pounds, but that's not most people, right? Most people, we are just like, to get some kind of fitness going on, you don't have to go bench press 400 pounds. You're just going to get hurt. So hope that makes sense to you. Copy Christian's email down right here. We want you to email us. We can work on getting you pre-approved, and then we can connect you with the realtor in Destin that Christian uses. We can connect you with the realtor in a different market if you want to invest somewhere else. We'll take care of the 2 hardest parts, the loan and the realtor, and then the rest of it should kind of fall into place for you.
I really appreciate that.
Thanks, Joe. Glad you joined, man. Glad you're in our world.
Thank you for having me on.
We'll
Bye.
see you on the next one.
Thank you. Bye.
All right, next up we got Kevin. Kevin, thank you very much. Kevin, let me ask you this. When I said, hey, click on the link below, did you click it right away? Because I noticed there was a delay before you showed up.
I did, but my browser and everything wasn't like set up to
Okay, no
check
problem.
the mic and the cam and all
If it
that.
was an issue on my end or if it was on yours. So
No, it was me getting set up.
Okay, cool. So do you mind asking the question that you put in the comments there?
Yeah, so I'm a house hacker. I house hack by the room. I love what like Craig Kurlop and Todd Baldwin and those guys are just like killing it with the rent by the room style stuff. I'm on my second house hack. I'm living in the master bedroom, renting out 4 rooms in the home. And I'm looking to get my third house hack, but having trouble qualifying for like the next home. So I hear different things from different lenders. One big thing is they're saying that I can't count the current rent that I'm bringing in on my current home because it's boarding income. My PITI on the current home is $2,700, and I'm bringing $3,700 while living there. So this is like before I even move out.
Not bad at all.
Yeah, if I move out, I'm going to make over $1,000, probably $1,200 for my room. So common sense would say like, hey, this, I've been doing this since 2020. I've had success with it. If you look at like how much money I'm bringing in compared to how much is going out, it seems to kind of make sense logically, but getting qualified for that next loan has been kind of a pain. Feeling a little bit frustrated. There's a home that's like around the corner from me. It seems like it's a good fit for like what I'm looking for, but I'm hearing back from lenders. Maybe it's a combination of like, how rates are and things like that, but just feeling frustrated getting that. It's been a year since the last one. I'm just like, I'm hooked. I want to do this, like, get rent by the room, house hack stuff. And it's just feeling a little bit stuck at the moment.
Which market are you in?
So I'm in suburban Philadelphia.
Okay.
There's a suburb there that's really great for young professionals, a lot of great restaurants and things like that. And I've had a ton of success getting tenants and things like that. I'll advertise and just have, people kind of lined up to rent there. So, I've had a lot of success and I just want to kind of keep it going, and I'm just feeling a little bit stuck.
Gotcha. Let me take this just because it deals with mortgage qualification. I'll say your lenders
take it because I took the last one, so
that's
you have to take it.
All right, unwillingly, I'll take that. So I will say, on the surface level, the other lenders are right. Boarding income, that is not incorrect. That is true. Conventional guidelines do not allow it, right? However, when you move out, let's say you're upgrading from house 2 to house 3 now at this point, we can use the market rent of the property to offset the house you're vacating. Now, this is a good way to look at it. Whenever you're utilizing something that most people are probably listening to this and think that's too good to be true, you're still living in the property and you're cash flowing. I think you shared $1,000, $1,200 a month. That's awesome. That's a home run, right? You're not even renting out the whole house and you're cash flow positive. Good job, right? Whenever you utilize a system like that, there's usually a con to the pro of the high cash flow, right? And the con in this regard is the limitation on mortgage qualifying. Now, what those lenders are probably doing is they're probably viewing your tax returns or your lease agreements, and they're saying, we just can't use that. But they're not realizing that when you move out, you can use the market rent of the entire property. Now, is that going to be $5,000 a month or whatever you shared with the room by room? Probably not, but it will be something, right? It'll be something. Now, if we were to provide your leases to the appraiser and he would, we could play games like that to get the maximum value that we could. But it's important to realize that it's not just a nothing or everything situation. It's not an all or nothing, right? You can get some qualification of income from that vacating property to buy a new one. Now, I'm assuming you'd want to use another 3.5% or 5% low down payment primary residence loan, correct?
Yep, that's kind of the ideal way. That's the whole thing with house hacking. That's kind of like one of the big things
100%.
is you
I
put
got
that low
you.
down payment and keep it going.
Yep, I got you. And that's obviously a pillar of being able to grow a portfolio in that way. Now, what I will say, another complication you'll run into is when you move within a short distance from your existing property, you'll run into primary residence guidelines where they want to see that there's actually an upgrade being had, right? So that's if, and I'll give you an example. We had a borrower who, I'm going to use a California analogy. You've probably heard of San Jose, Silicon Valley. It's where all the tech companies are, right?
Sure.
We had a borrower living in a $2 million house in San Jose who tried to make the argument that he was going to move inland over to Modesto and buy a $600,000 duplex. And he was going to live there, 3.5% down FHA. No problem, baby. Right?
Mm-hmm.
I'll ask you, not being a mortgage professional, do you buy it? You think he's actually making that move? Or does that sound like a tech millionaire buying an investment property?
Maybe the latter.
Right? It does. So there is an amount, and this is where people don't, it kind of gets convoluted because loan officers typically aren't very open, because then you learn everything you need to know and you can shop around, right? There's a certain level of kind of common sense guidance that goes into loan underwriting where, like, does this make sense that this would actually be your primary move? We had somebody who tried to buy the house next door and convinced the underwriter that it was their primary. Well, what are you not having in your current home that you're upgrading to? And the rules basically come down to, is there a substantial upgrade? And I know that's not A or B, it's not super clean cut, but a higher purchase price, more square footage, better amenities, a better school district, stuff like that helps. But it needs to be a very clear, I'm moving from a house at 2,000 square feet with roommates into a house for 3,000 square feet, and I see an upgrade here. This is going to be my quality of life. I'm going to be able to move my old grandma in with me that I'm being a caretaker for. We can kind of tell that story a little bit, right? Mm-hmm. That's the hurdle that you're going to go through. And it's super easy to just say, go use an FHA loan every year, and nobody really tells you how to do it, right?
Right.
Those are the guidelines that if you plan it effectively and you plan an upgrade every year, that would be the way to best accomplish that. And also target a property where the rent is going to be enough to cover the mortgage. So in your instance, I don't know what your market rent for the entire property would be, but let's say, I think you said your mortgage is around $3,000 a month. Let's say market rent's $2,500. Fair, right? Well, that's only a $500 discrepancy. At least we can knock off, 70, 80% of your mortgage in qualifying you for a new home. And while you still need to make that up in your W-2 income or 1099 or whatever you do for work, we're still crediting you with something, right? Okay. And then what's really nice is in future years, you go and report the actual income that you're making on tax returns, and we can use that instead. So now your income went from you just barely qualifying for this new move to now when you're moving to house number 4 or number 5, we're upping your number every year because you have one more property being converted to tax returns, right? And tax returns are like, that's the truth. That's what you reported. That's what you made, right? So now we can start really scaling because your income's actually increasing every year instead of just adding on more debt, right? So this is where it becomes really important to like get your loan officer and your CPA to be good friends with each other, because we can kind of tell your CPA how to make things look. David knows how this works because his CPA and his loan officer don't like his file. I promise you that. But that's very common with self-employed people, with investors. We can kind of make it look pretty when we need to, right?
Okay.
So Kevin, one thing I would like for you to take out of this would be Christian's telling you like how the whole thing works, but you don't actually have to know any of that. If we do your loan, he and your loan officer will tell you, I will go figure out how to convince the bank or the lender or whoever that this is your primary. He's telling you like what we do. You would never be talking to the underwriter or whoever to make that argument. You just got to get a loan officer or work with a broker that intimately understands your file, that can tell your CPA, hey, write it up like this. This is how we do it for ourselves. Then we can get him qualified. And then we'll tell you, buy the properties that work this way, do it in this manner, and we will be able to keep going until we get to this point, right? And that's kind of how I built my portfolio. I asked the lender, what would I have to do to make it happen? They told me. I went out and used the principles that I learned on Bigger Pockets to make it happen. But I don't want you to think that you got to go figure all that out, right? If you're talking to a bunch of different loan officers and saying, well, Christian said you got to do this, they're probably not a Christian. They're probably not a David. They're probably not a person we have. They probably can't, right? They just know square peg, round hole, try to make it happen. And then they don't, right? And that's how most people do their jobs. We're different because we buy properties ourselves. So when we get told no, we don't get the luxury of saying, it doesn't work. I could do this. We have to find a way to make it work. So if you were good, I would email Christian and I would let him know like, hey, I want to try to make that happen. Christian could have one of our guys that connect you with them, look at your file, tell you, here's where you're going to run into problems, or nope, as long as you set it up like this, we're going to be good. And then you can just house hack a house every single year. And then I advise you to get into the bigger, better, nicer properties. Every year you want to get into a better neighborhood, a better property, something more rare, something that's going to appreciate more, how to add more bedrooms to it, whatever the case may be. So even though you may be doing the same thing every year, you're doing it in a better way. You're not stuck in a rut, just kind of repeating the same action.
100%.
Right.
And we are freshly licensed in Pennsylvania, so I can confidently say we can help you out there. So obviously not a pressure sale, but would be happy to help and kind of build out that strategy and that roadmap for you. And then you just walk the road we pave, right?
Yeah. I think the tax returns might be holding me back a little bit. So I have like maybe 4 months or 3 months worth of like income from this current house.
Got it.
I did a renovation recently, added a bedroom. So like
Awesome.
now I'm making more, but that wasn't on the tax return. So I don't know if it's a combination of what my CPA uses deductions and things like that, but I'm finding that my qualification number is lower than the price that I bought my current house at. So
Yeah,
it's
gotcha.
like I couldn't upgrade even if I wanted to. I'm feeling like kind of stuck in that way.
I gotcha. Yeah, and that's where our team could kind of help you build that roadmap, and you know, if it doesn't work this year, we'll tell you what you need to do next year to make it work, right? That's all part of the game plan.
Yeah. Okay. Yeah, that all makes sense. Yeah, it's a shame that I just feel like, you know, it's been a year. I want to go into that next one. It's just feeling, I don't know, just feeling a little stuck there.
All right. Well, thank you, Kevin. Anything else we can help you with before you go?
No, I think that's it. I appreciate your allowing me to jump on here. This is awesome that you guys are able to do this, and I appreciate your time.
Absolutely, man. Hope we can help you.
All right. Thanks.
All right. Christoph, you had a good question, and I told you to click the link, and then you said I sound like a salesman. So now I'm going to ask you to come on and tell me why you say I sound like a salesman, and tell me if you think that is good or bad, because I am a salesperson. I have started companies to help people do the same thing that I do, so that I don't refer them to people to do this that I don't have any control over, and I don't know what kind of service they'll be getting. I don't understand why, if it was meant to be disparaging, why that would be disparaging, because I do want the people who are here to work with us. That is why we're here talking about this. This is why we come up with loan products that will solve the problems investors have. This is why I use those products. So please click the link on StreamYard and come in and tell us why you are saying that I sound like a salesperson. And I will open this invitation up to anybody. If there's anybody else here who hears me say you should email us so we can help you with that and doesn't like it, explain to me why you would come to this YouTube live, you would ask questions, you would learn from us. You trust us enough to tell you what to do, but you wouldn't trust us to do that for you. Explain to me why, if you're saying, David, what property should I buy? How should I buy it? What should I do? What loan should I use? That I would say, use the people I use. And you would say, you sound like a salesperson. I don't understand that. If you don't trust me as a salesperson, why would you trust any of the advice that I'm hearing? Why would you ask questions? I'm trying to understand what is in your head. So in the meantime, we're going to bring in Legacy REI Properties. And Christoph, please don't get scared. Come in and make your comment known. Hello there, miss. What is your name, or do we call you Legacy?
Hi. Oh my gosh, I can't believe I'm actually on the call with David and Chris. Thank you so much. My name is Folly, Folly Walkway. And I would love to ask you guys a question about kind of next steps with moving forward as we grow our portfolio. So my husband and I, we currently own 16 units. We have house hacked. We've used DSCR loans. We have also used just a conventional 15% down on single family. And now we are actually moving to Austin, Texas next week for a house hack. Now we are trying to buy an apartment building, 5+ units. And we have done a lot of renovations within this last year. About 8 units we've renovated. So we have some cash in the bank, but we don't have a ton. So we do have about $300,000 in equity that we could potentially pull out from our portfolio in Little Rock, Arkansas. How would we go about buying a 5+ unit with this scenario?
That's a good question. With 5+ unit, I guess I would ask for a little bit more info, because we have our DSCR product actually goes 1 to 8, and we have one investor that'll even go 1 to 12 units. So are we talking 12+ or between 5 and 12?
We feel like maybe we should get our feet wet. So we're open to the 8 to 15, 20 unit space.
Awesome. So if it is 8, that would fit in our normal DSCR product, which is good news. If you do get in that 12, 20, 25 range, that would be just a tried and true commercial loan, right? That's probably going to be 25% down at maximum. At minimum, maximum loan to value of 75%. And commercial properties, if you're not familiar with the space, they're usually appraised and valuated based on the cash flow of the property. So it sounds like you've kind of been in the residential space. In that space, everything is comparable based, right? So like, what did the house down the street sell for? What did the neighbor sell for? What did the guy across the street sell for? And in commercial real estate, all that goes out the window, because one apartment complex is not like the other, right? Depending on how many, late clients you have, how many below market value clients you have, how many units need renovation. All that goes into place. It's the same thing as buying like a gas station, right? Commercial property is just based on the income approach. So your loan limit is honestly going to be evaluated based on that model, right? So is the property, a lot of people ask for, if I get the property renovated, what they don't understand is, they hear 25% down on commercial properties, but then 16 out of the 20 units are below market value, and we can't even go to 75%, right? We can once you stabilize it. So your first question was, how can we access the equity in the Arkansas properties? I would say you guys have over more than 10 properties, so conventional lending's out the window. That's where David and I find myself. I would say DSCR's your best bet, and you said you had some experience with that loan product. You can do cash outs with DSCRs, right? Usually up to 75 or 80% equity. I would say go grab as much of that as you can, and then run some numbers and run some situations past whether it's us, whether it's your lender, whoever you want to use for the commercial space, and kind of get some idea on what your down payment required would be, right? Like run some 20 unit purchases that have happened in the recent past, see what those purchase prices were, run 25, 30% down of that. If you got that, go find some properties that work, right? That would be my initial starting point for sure. Okay.
So I guess you're suggesting that we do like a cash out refinance of our portfolio. Would that be
that would be the only way to tap into the equity. I know a lot of people are referencing HELOCs right now. HELOCs on investment properties are almost impossible to find. If you got a small bank or local lender that will do it, go do it. We don't offer it. We don't do HELOCs on investment properties, unfortunately. So I don't know what your interest rates are, but it would be a cash out, which it would obviously replace that first loan that you have currently. That's definitely where I would start. And I mean, if that difference in interest rate, the conversation I always have with people when they're, most people have the 3.5% and 4% interest rates from a year ago. Obviously, when you refinance, you replace that with a 5.5% or 6% that you're getting now with conventional rates, right? When you're adding on that $1,000, $2,000 a month in your mortgage, whatever it is, you have to run your numbers as if that cash that you're taking out can compensate for that loss you're realizing on your mortgage, right? So this $100,000 is going to cost an extra $1,000 a month. Can I go make $1,000 off a $100,000 investment? If the answer is yes, who really cares? You're making a net profit at the end of the day, right? That's the biggest thing. So I would say start with that, run some numbers. If you want our help to do it, I think David can throw up my email down there, but that would be my first start, is just start laying that roadmap to understand, hey, what do we have to make just to break even here, right, on that debt that we're taking on? Right. I'll pass it over to David for some added advice on that.
Let me ask for your opinion. It was a Folly, right?
Yes.
Thank you, Folly. Is it Folly or is it spelled differently?
No, it's FALI.
Ooh, that's nice. I was going to guess like FAHLY or something, but FALI. Does that mean something in another language?
Yeah, so I'm Nigerian, and so Folly is my full name, so it means precious.
Oh, that's
nice.
awesome.
Yeah.
I like that.
Yeah, Thank you.
So, a side note, how do you feel about Kamaru Usman being robbed in the 5th round of the last UFC?
I mean, I think he's always great representative of Nigeria. It's always
He's a classy man, isn't he?
It's sad, but as
Even in defeat, he was classy. Right?
yeah, he's great.
It almost feels like God had him lose on purpose just to show
Yeah.
everybody how much class he has. Because if he won again, it'd be like, well, of course he's winning. He's
So he can lose too.
And it was like he lost, but he won the entire fight, and everyone knows he's better. And it was very clearly like a lucky shot that took him out. So even in losing, he still looks like the better man.
I know he'll always be a winner in my heart. So
that's awesome. All right, so I was going to ask you, what are your thoughts on what Christian said so far?
Yeah, so it looks honestly doing a cash out refinance. Cash out refinance. It sounds a little scary to kind of change our equity position and then get out higher interest rates, but it's all about the numbers. So it just depends on like doing the appropriate numbers on that. So I guess from there, I would then ask, okay, say we've done that. We've done the cash out refinance. Where I guess it's like so we're still working our W-2s. So I'm a nurse. My husband's a physical therapist. So qualifying based on income, do they want to see, if we had an 8-unit plus and we can qualify with you guys, do you guys want to see, hey, they have $300K in their bank account, or hey, they have $200,000. Like, what do you guys want to see from that point of a cash out refinance?
For the cash out refi, no, it's a cash flow based loan. So as long as your property is cash flowing, that's the main determining factor. That's why it's called the DSCR loan. Debt service coverage ratio does the debt service the debt coverage, right? So no, sometimes there's some minor asset reserve requirements of like 6 months of the payment, but if your payment's $2,000, that's $12,000, right? Now for the commercial loan, there's sometimes some more reserve requirements, but ultimately it's underwritten the same way. Like the DSCR originated from commercial lending, right? Does the property cover the debt? If it does, we're willing to lend up to this percentage of the property value. So no, they wouldn't really look into your W-2. If anything, it would just be a compensating factor. Hey, if this property crashes and burns, there's still nurses and physical therapists that make $150,000, $200,000 combined household income. Cool, right? Yeah.
Okay. Yeah. So to answer your question, I mean, it's a different realm for us just because we haven't been in this space. So it's a little scary. But we're just hoping to trust our numbers and
you should feel good that it's scary because it's scary for everyone. There was never a time it's not scary. And I'll let you in on a secret. Even now, Christian and I get scared when we have more properties. Okay. I'm telling you the truth.
David and I have very honest conversations, right? Like we really do. I'll tell you, on your first residential purchase, was it scary?
Yes. Yeah, it was a room rental. Yes, it was. I was what am I doing?
I'll ask you now, are you glad you did it?
I am, absolutely.
Right? Yeah. So it's funny how it's never scary in hindsight, right? Like I'm not scared that we bought this house. I'm really thankful now, right? But it was scary. This was a 1 point whatever we bought this for, David. This was a very expensive purchase that we were scared.
I would bet Christian would not have bought that house if I wasn't pushing, and he's like, well, I don't want David to think I'm scared, so I'm not going to tell him. But there was like 3 houses, and that was not the one Christian wanted. He liked the other 2 that were cheaper and nicer.
I did like the other one. That's true.
I kind of twisted his arm and he went with it, but it's already gained a couple $100,000 in equity. It's like a flagship property. It's in the best location. So what happened is he brought the deals and I said, okay, of these 3, because I had never bought in that market before. He had been there before me. Which is the best location? And he was like, oh, okay, this one. And I said, all right, that one also has the biggest lot. It has the best amenities. It has the most square footage. It has the most parking. It has the most ability for us to manipulate it and maneuver it in different ways and add value to it. What do you like about the other ones? And he's like, well, they're going to show really good in the listing photos, so people are going to book them. They're going to show really good in the listing photos, so people are going to book them, right? It just felt safer because they were cheaper. And they are. They were cheaper properties, right? The ROI might have even looked a little bit better at the time because they were less expensive, but that we ended up getting this one, and it ended up being much better for us. It's appreciated more than the other ones have. It books more than the other ones do. We ended up getting a better deal on it because there was less buyers competing for it. It was still multiple offers, but it wasn't as many multiple offers. And the listing agent marketed it poorly, frankly. Like, they didn't show that property off to be as good as it was. The other ones were very well marketed. They looked better than they would have in real life. So we felt fear, right? But it was basing the decision on fundamentals that I was asking, what's the best location? What's the size? What has amenities that others don't have? That ultimately we look back on and go, oh yeah, we're so smart. Let me brush my shoulder off here, right? Like, it's never that way though. He's telling the truth. When you're looking forward, it is terrifying, or at least if not terrifying, still scary. Even for me, like, I just put one under contract 2 days ago. Okay. Biggest house I've ever bought. Christian looked at it and didn't love it. And I looked at it. It was the first house my realtor ever brought my way in that area where he's buying. And I'm like, nope, not going to like it. It was priced much higher. The price came down significantly. And then I got it for even less than the price it came down to. But I had to ask him, like, what do you think about this one? He's like, bro, I don't know about that. Like, it's not what I would have thought. And I said, okay, well, why don't you like it? Now we start diving into it. And he came back and he's like, well, I guess because it doesn't look like the traditional houses that we normally look at. And it's huge. It's like 8,000 square feet. It's like the winter,
very big,
right? Like, no one buys a house that big. Just the sheer size of that house being 2 times bigger than the biggest house you'd ever think about buying gives you a feeling of like, fear, bad idea, don't do it. But when we dug in and we were actually like, why not? We couldn't find an objective reason why I shouldn't buy the house. So even though I am scared, even though I'm like, why am I doing this? It doesn't look like anything I did before. I'm pretty sure I'm going to look back in a year or two and it's going to be worth like probably $400,000 or $500,000. It's probably going to appraise for $300,000 or $400,000 more than what I paid for it alone. Okay. Yeah. And it's going to be an awesome deal. And I'm going to be on one of these YouTube lives talking about this. I did this thing and I'm so great. I'm David and I always buy the best deals, but that doesn't mean when I was doing it, I wasn't scared. So don't let that fear make you believe that you're making a bad decision. Let the fundamentals tell you if you're making a bad decision. If I was to say to you, I will give you $100,000 right now at 8% interest to go buy another house, would you take my money?
Yeah, I would.
Why would you take my money?
Well, it's $100,000 and we can get that and we can double that money if we use it correctly.
So you think you can make more than the 8% you'd have to pay me to use it?
Yes.
Okay. So what's the difference between taking my money at 8% and getting a HELOC of $100,000 on your house at 7% or whatever it is?
Not that much of a difference, except the 7% is better.
The 7% is better. I think the reason you're afraid of the HELOC option is because you gave it away when you were describing it. You said our equity. Okay. Your brain sees it like you're losing something that you've gained, something that is safe. It's something that makes you feel secure, and you are risking it by investing it. But the reality is, if you took $100,000 from me, it's no different than taking it against the equity of your own house. It's still just $100,000 that you owe. In fact, it would be safer in many cases to do what you're doing because you control the terms of when you pay that money back, right? If you give a loan to me, I might be like, no, you got to pay me 8% interest. You got to pay it to me for 3 years. When it's a HELOC, you can go get it, spend it on something, get some equity out of it, go pay your HELOC off. Maybe you don't have that option with me. So I'm only saying this just to kind of like put it into perspective. It's totally normal to be scared. Overcoming our fear is a bigger part of building wealth than just knowing the information. 100%. Okay, I can bring some people into these lives that know literally more than me, that have listened to every single podcast ever done, read every book, that can spit and recite facts to you that are brilliant, that have no money because they can't go take action. And I can also go bring in people here that are worth more than I am and that know 10% of what I know. Their stupidity helps them because they only know the 10% that matters and they don't think about anything else. They just go take massive action, and Christian's seen those people too. So like the difference
loans for them.
What's that?
I said we've done many loans for them.
Yeah, it's a good point. I'm not saying be stupid. Okay. What I'm saying is whether you gain more information or you don't doesn't impact the wealth you build. It's the action you take. And fear is what stops us from taking action. So you got to get comfortable with that fact that every house you buy, that voice will always be there. But Christian gave the right point. If you can borrow at 8% or 7% or whatever, the only question to ask, or there's 2 questions to ask. The first would be, can I earn more than the 7 or 8% on what I buy? And because he mentioned earlier, real estate makes you money, and he said 3 ways. You can make an argument 5 ways. It's multiple ways. Okay, you're going to earn more than the 8% unless you really screw this up. And the second question is, in a worst case scenario, if somehow black swan event happens and I lose that 100 grand, can I afford to make that HELOC payment of 8%? And the answer is yes. You and your husband both are gainfully employed. You're probably good at saving money. You could probably work overtime if you had to. So in a worst case scenario, you're going to be fine. It's just going to set you back a little bit. This is actually not nearly as scary as what you're thinking.
Yeah. And I like running this fun exercise. So I'm gonna ask you a couple questions here. So David started with, if I lent you $100,000 at 8% interest, so that's $8,000 a year in interest charged, would you take it? You already said yes, but let's pretend your answer was no. Right? Okay. I'd say, okay, let's imagine it was a tax write-off and you could depreciate whatever you purchased with it. It gets a little better, but let's say your answer was still no. I say, okay, well, let's say that you go, give me a rate of return you think you can get on a property.
Let's say 11%.
Okay. So let's say for every $8,000 you pay me in interest, I'll pay you $11,000. Fair. So now it's getting a little bit better. And I'm saying, oh, by the way, you get to keep the asset that you buy with it. Okay. Getting better. Oh, and if the market goes down, I'm not going to foreclose on you as long as that you use 8,000 out of that 11,000 to continue paying me. Mm-hmm. Getting better. Oh, and by the way, you can also continue to pay me off so that in 15, 20, 30 years, you don't owe me anymore, but you still own the asset. Okay, and once you start building up all these things, it's like, man, how do I invest in anything else? I'll be honest with you guys, I don't own anything in the stock market. I just don't. I can't justify it to myself in my mind.
Let me ask you a question, Christian. Can I pay you back your money with money that I got from someone else, like maybe a
sure. On that new or that new asset that you just purchased, you can go to somebody else like me, take a loan off of it at a better interest rate than what you're paying me, and pay me off, and I'm happy about it.
That's okay too. I can refinance it and pay you back, and you'd be all right with that.
Okay. The moment the market, and by the way, the moment the market shifts in your favor, you can pay me off, but I can't do that to you. So your interest rate's fixed. I can't do that, right? If you're locked in at 5% and the market goes to 8%,
what if inflation keeps going up? And I charge more rent every year than I did the year before, so I make even more than the 11,000. Is that okay with you? If as long as I'm paying you back,
I'm only asking you for 8. I mean, we're being a little facetious here, but you guys can see that once all these things start compiling, it's like compare that to a stock that pays a 5% dividend. It's like, I've asked myself, like, how did I ever have money in that asset class? Like, it just didn't make sense to me. And then people say, oh, what about a crash? Well, what is the stock market down this year? What is the real estate market down this year? Like, if we're going to lose money, if the world just accepts that every asset class, what is crypto down this year? 90%, right? If the world just agreed that we're going to have 1 year where everything loses money, what's the asset class that lost the least amount of money this year? Like, what is it? It's probably real estate. People are saying the world's burning because real estate's down 10%. Well, the stock market's down 30.
And you know what's cool about stocks?
Down 80.
When your stock market is down 10% and you you lost that money, you can't get it back. There's nothing you can do to fix that, right? When the real estate market's down 10%, you didn't lose that money unless you sell. You just keep renting. And even though your value of your asset went down, usually your cash flow just goes up because rents tend to increase, right? So even when the worst case scenario happens and the value of the asset drops, you don't ever feel that. I don't want to make it sound. In fact, the next question, Folly, I'm going to let you go here unless you have a follow-up question. The next question I want to ask you guys is, who wants to come in and challenge us on, like, this seems too good to be true? How could it be that real estate, you never lose, right? Nothing ever is that good. I'd like to kind of go into the why behind why we're this confident when we talk about it, when other assets like stocks and crypto and stuff are much riskier. So did you have a last question, Folly, we can help you with before we get? I like that you're smiling more now. That makes me feel better about the
You see how we can act through fear a little more confidently because we've thought of this and we've had these conversations, but I'll leave that to you. Go for it, Folly.
No, just thank you guys so much. Very helpful. David, love seeing green. Like, keep doing that. That's
Can you come on and ask me a question there? Will you commit to that?
Okay, I will.
I'll
Yeah.
put the link in the comments here for you guys to if you want to go on Seeing Green. It's bigger.
Yeah, guys, go do that.
That
That show is only as strong as your guys' questions, and obviously David's awesome. But go on and ask questions. Like challenge David. Like give him some really good questions to have him answer, because the content really comes from you guys on that for sure.
Okay.
Thank you, Folly.
All right. Thank you.
Okay, who here wants to say, I don't believe you guys, you're salespeople. This is too good to be true. There's no way that you never lose money in real estate. There's no way it's as good as you make it sound. I love those type of challenges because it gives us a chance to pick apart, dissect why real estate works this way. And if you understand, it's basically a hedge against bad decisions that the government and other people have made, that the only reason any of us make any money in real estate is other people made bad decisions with their money. And it's just a redistribution of wealth from those that can't save money, that can't delay gratification, that don't gain knowledge, that just go make foolish. Imagine that like a casino worked in a sense that the house had no money. And the only way you could win money is if someone lost it. Acts like an actual poker game, right? If you were really good at poker, you would never say poker's a scam. It can't be true that you always win. Well, it is if you're good at it. If you're playing against people that are worse than you, and the only way you win is if they lose money, you wouldn't wonder how it could work that way. People just don't understand that real estate is a form of poker, and you guys are all here getting an education on how to play poker. And you're competing with people that don't understand the rules, right? You ever play with that person who's just learning and they're like looking up on their phone, does 3 of a kind beat straight? And they don't remember the rules, or they're like, they fold when they should check. That's like one of the first things that every new person does, right? Like they don't like their hand. And so it comes to them and they're like, I fold. And you're like, no one raised. You don't have to fold. But now we know you have nothing, right?
All the time at house games.
There you go, right? That's how you know you're playing against someone that's bad. That is everyone else who's buying houses that aren't here listening to this. To them, real estate is some great big mystery, and they hope it works out. But to people that like us that look at how it works and kind of understand it at a fundamental level, it's really not nearly as risky as it is for other people. You just won't lose at it if you do it the right way, because other people will. Right? I should not have a tenant for every house that I have. There shouldn't be tenants out there renting properties all the time. Maybe 10% of tenants should be tenants, right? The kind of person that should be a tenant is the person that moves around a lot and doesn't make sense to buy a house and spend closing costs. That should be a tenant. Or they don't want the responsibility of fixing things. People that are just needing a place to live for 5 years should be buying their own home for sure. They're not doing that because their credit's bad, or they can't save money, or they can't delay gratification. They have no self-control. It's a character flaw. That's why they rent instead of buy. And I'm not here to put those people down. I'm grateful for those people, because then I wouldn't be able to own houses if it wasn't for them. But I am saying that doesn't have to be you. You don't have to be that person that never makes money because you can't delay gratification and you can't save money and you can't rearrange your life around your goal. That's what anybody does. If you want to be good at something, if you want to be in better shape, you rearrange your life around working out at the gym and eating better food. You prioritize going to Whole Foods or some healthy place. You meal prep and you eat the stuff you made, and you prioritize going to the gym. If you want to be in a good relationship, you prioritize doing the things that make the other person feel valued, and you put into it. It's not an accident that you ended up there. It was a purposeful thing that you rearrange your life to do. If you want to be good at your job, you spend more time at that job, studying that job, chasing excellence at that job, and investing in that job so you can be better than other people. This is not any different. And many human beings are not willing to do what you guys are willing to do. They're not willing to do, like, I can't remember who it was that we talked to. If you remember his name is Chris or Ryan, maybe the beard and the camouflage hat from Philly, who said, I rent a room in my house and I rent out all the other rooms to other people. 95% of Americans are right off the bat, nope, that strategy doesn't work for me. I need my space. I need my comfort. I need my privacy. I could never do that. Okay, well, then you don't really deserve to build wealth through real estate. If your comfort is that much more important than your future, you're not willing to delay gratification, you're never going to be someone who builds a lot of wealth. If you guys are willing to do that, you deserve it. I was actually watching a video today. I don't remember who made it. I think it was like CNBC, about skyrocketing rents in New York. And there's all these like single millennials in New York complaining about how their rent is so expensive. It's $3,500 a month. It's $4,000 a month. I can't save money because all my money goes to rent. And I was listening to that thinking, why don't you rent a room or a couch from somebody else and pay them $1,000 a month and save the extra $3,000 that you've been spending, and do that for 3 years? And if you can save $3,000 a month for 1 year, that's $36,000 over 3 years. That's $100,000 that you now have that you could go buy a couple houses, right? You delay gratification for 3 years and you could go buy a house. But no, this person said, I have to eat oatmeal sometimes for dinner because I can't afford anything more than the 2-bedroom apartment that I have in the location where I'm close to work. Okay, you're willing to sacrifice eating oatmeal every night, but you're not willing to sacrifice renting a room from somebody else or renting out your rooms to somebody else because of the comfort. Okay, like I don't mean to go on a rant here. I'm just explaining real estate is not a scam. It's not a too good to be true. It's you taking advantage of other people that are not willing to do the hard thing. If you are willing to do the hard thing, the wealth will find its way to you. Sir Julio says, is David hiring team members for his SoCal office? Yes, we are. You 2 ways that you can sign up for that. You can go to the link here, davidgreen24.com/careers, or you can send an email to info@davidgreen24. That would be this email right there. So if you want to work for us, go to davidgreen24.com/careers. You can get connected with the One Brokerage as well. If you guys would like a career writing loans, we are hiring loan officers, especially if you already do it. We would love to talk with you. All right. Christian, any thoughts on that little monologue I just went on?
No, I was actually going to just share a super quick story. Because you started off that whole thing on, we were talking real estate versus investment and other people coming in and challenging us. If you're cool with it, I'll take 3 minutes here. I'll share my mom's initial investment story, which I think is really powerful when spoken in this context, because people now are having 2008 vibes and they're thinking crash and all that. So if you guys could weather me here, I think that everybody in the chat here would agree that the worst time to buy property maybe in the history of America was 2006 to 2008. I think that's fair. My own mother purchased during that time. She purchased at the height of the market, she was the classic W-2. She was a nurse, actually. Put all of her hard-earned money. She put $100,000 down on a $500,000 house, put 20% down. And within 3 years, it was worth $350,000. She was 50 grand underwater. So I want to use this as an example because this is a really strong example of the strength of real estate and the ability to withstand times like this. Now, I want to mention she was an individual who was a working professional who had a career that was unimpacted. So that's fair, right? I'm not saying this should be the waiter or the, whoever it is that wouldn't be able to withstand a recession in the same way that a healthcare worker would, right? So she bought within her means. She could comfortably afford her mortgage payment. She had a dual income household with her boyfriend at the time. She was capable of doing this, but I still want to share with what she went through that was arguably the worst time ever to buy real estate and what it eventually led to. So 2 years later, it was worth $350,000. It's funny because you hear of all the foreclosures and everything that happened in 2008, but her bank did everything in their power to help her make her mortgage payment. They offered her home loan modifications. They offered her, 1 and 2 year interest rate deduction so that she wouldn't foreclose, all these things. And she was in no danger of foreclosing, but everybody was rushing to help, which I thought was super interesting, right? Obviously, the people I'm not saying this happened for everybody because there were people who lost their jobs and who were very impacted during the recession. But buying within your means, everybody was rushing to her help to make her mortgage. And within 5 more years, by 2 years, 2010, going into about 2013 to 14, her area she bought in Los Angeles, California had rebounded. It was worth $500,000 again. She did a cash out refinance up to 85%, and she paid to send me to Berkeley. So I'm a UC Berkeley graduate, for those of you wondering. And she paid for her to go back and get her master's in nursing. So this investment that was arguably the worst time ever to invest in real estate led to 2 upper graduate degrees, led to her staying in her home, saving money on rent that had increased to $3,000 or $4,000 a month, and she was still paying $2,500 a month. And the best part, in 2018, she sold that house for $600,000, $100,000 more than she bought it for. And that was the down payment for her dream property. She bought $1 million home. And that was purchased at the worst time ever in recorded American history to buy real estate. Like the worst, maybe outside of the Great Depression, which when the real estate system was completely separate. It still led to her saving on rent, paying for 2 educations, buying her dream home. Like it still won. It's still one compared to every other investment asset. And she got an interest rate write-off. She got all the write-offs for the points that she bought down on both of her refinances. So like I like telling her story because it really brings some realism into this advice that we're giving, because we've seen people who bought in bad times. Like if you have the stability to see it through, if you have the long-term mindset to be able to withstand a downturn, it still works. And it works really well. And it leads to you being able to build wealth in ways that I don't believe is doable with other investment vehicles. So that's my rant, David. Both of us got one rant for the night, but I think both of them are really good.
I'm still waiting for someone to come in so we can explain how on earth your mom bought at the worst time ever, probably didn't get below market value when she bought. She didn't get
bought over market value, over by 10 grand.
Bought wrong, worst market ever. Client came out of it on top, making $100,000.
Yeah.
I know exactly how that happened. I'm happy to teach you guys how, but I need a human being to say, I will be Spartacus. I will sign up and I will ask questions and get my free education from David and Christian and how on earth this happens. Because I will tell you what, guys, we're in another one of those markets right now. We're in a market where nobody knows what's going to happen. It could go down more. It's already gone down some. No one knows. The reason I have confidence to have bought, I don't know, Christian, I think I was at 15 or maybe
15,
16.
I think.
The one I just,
I think the newest one 2 days ago is 16.
16 or so houses in the last month and a half, because of this very fact that I will share if someone is bold enough to come in and listen. This could be viral. This clip could go viral and you could be famous. You could find it within you and have the intestinal fortitude to click on the StreamYard link that is in the comments and ask a question. Christian was just trying to figure out what intestinal fortitude meant.
Yeah, that was a bold one.
You can call it coaching. You can call it mentoring, Lamont. You can call it whatever you want. I just need you to call in. Okay, Angela, Miss, what about purchasing multifamily and how should we buy? Can't you just humor me here and click on the StreamYard link so we can talk about what we want to talk about? And then maybe you can ask your multifamily question. Here, guys, let me put it in the comments in case you're all saying, David, I want to do this, but I don't know how. Here we go. Now the link is in the comments. Click on the thing underneath David Green Real Estate. Come into the studio and I will explain to you why this is not a magic. This is not a mystery. This is not a too rich to be true scheme. It's actually very sensible why even if real estate goes terrible, you will still make a whole bunch of money if you can wait for long enough. Otherwise, we will do an entire different YouTube live on this topic and somebody else will get all the credit that could have been yours if you clicked on the link. So you guys are kind of making me be a salesperson right now because nobody's coming in, right? I'm trying to sell you on why you should click it. I don't want to be a salesperson. Mirbani says, I bought in the pandemic in Florida. Best decision ever. That is true. Getting into Florida at or before the pandemic was a very good move for anybody that did it. But I'll bet you when Mirbani actually did that, they felt like this could be a terrible idea. They were hearing people say, there's a recession, there's a depression, we're going into the worst economy that we've ever had. The sky is falling. It's all falling apart. Coronavirus is going to kill half of the U.S. population or more. It's going to be, what was the zombie movie with Will Smith and the dog? What movie was that? I Am Legend. Yeah. I was thinking iRobot. I got my Will Smith movies mixed up.
It's not the one.
It's going to be I Am Legend. It's going to be Mad Max Beyond Thunderdome. It's going to be the Hunger Games. It's going to be something terrible. And then it wasn't terrible. And the reason it wasn't terrible is what I would tell you guys if you would click on the link there. But if you guys aren't doing that, we're probably going to wrap this up. And Christian and I will do another one of these where we will share with you guys. Okay, Angela, we might have the right person here. Let's see. Angela, can you turn down the volume on your, or can you actually pause maybe the live that you were recording there? There's a bit of a
Yeah. Okay. I paused it. So I'm really looking at getting into multifamily, want to know the best strategy and the best geographical area to purchase multifamily.
I would like to help you with that. Unfortunately, that would then be making myself a liar because I said I would only talk about the reason why real estate performs well, even when it does terrible.
Okay.
So how do you feel?
We know it performs well.
How do you feel about getting a free education on that topic? And then at the end of it, I'll answer your question about multifamily.
Okay, super.
We originally were going to make this entire thing about different loan products, but then nobody asked us about those. And of course, we got stuck answering the questions that came. And so we didn't even get to share as much about the loan products as we wanted to. We're going to have to do that again in the future. All right. So, Angela, have you ever wondered how Christian's mom could have bought a house at the worst time ever in recent history to buy a property, overpaid for it, and still made money? What would your guess be on how that happened?
Wow. I would have to say the way she structured the loan, the way she structured it.
Now, let's assume she didn't do anything to structure the loan at all. She just signed whatever paper her loan officer gave her, and she said, okay, I'll do that. But
I'd like to learn how she did that.
Well, she just signed the documents. The loan officer just said, here's rates, do this loan. And she said, okay. Didn't know anything about what was going on, and she still made $100,000 doing everything wrong. How do you think that is possible?
Because it was in a down market and it's going nowhere but up.
Nope. She bought in an up market that went nowhere but down.
Oh my, tell me about that one.
That's what we're talking about here. What Christian's saying is she did everything wrong. Okay. You could buy in 2006 at the height of the market. You could overpay for the house. It could have even not been a great opportunity. It wouldn't have cash flowed. All of that goes wrong. And
Funny addition, it was on an interest only arm.
Wow.
All literally the horror story of what you heard shouldn't have happened in 2006 to 2008 was my mom.
No way. Okay.
Yeah.
Tell me. Oh, I want to know how she did that.
You're watching the movie and the dumb teenager in the middle of the woods is making out with their boyfriend. And then they see someone with a chainsaw come. And instead of running right to the road and getting in the cop car and getting saved, they turn around and run into the cul-de-sac where they go into an abandoned home and they run into a room full of knives, swords, and chainsaws hanging from the ceiling. Why would you ever do that? And that's what his mom did. Okay. And many people did that because they didn't know how real estate worked. Here's the key, Angela. Every time we get into a position in our country where we are being threatened by a recession, rather than letting the people that made bad decisions, like the people that bought a house without knowing what they were doing, Christian's mom would have been fine. This is not intended at his mom, obviously, because I would treat her like my mom. But what we call it is the stupid tax. When you make a bad decision, you get taxed on being ignorant, and you figure it out and you pay your tax, and then you do better on the next one, right? His mom eventually would have said, Christian, you go invest, which is what she does now. She just gives her money to Christian and he goes and gets a really good return on it, right? Right? She got lucky. She didn't have to pay the stupid tax because things turned around. But had that's what we should do as a country, right? We should all, for making bad decisions, pay a price, learn, get better, move on. The reason that we don't have to is because every time we go into a recession like we did in 2008, 9, 10, the government prints more money.
Right.
It's that simple. Every single time we should pay a price, the government says, I can't have people paying prices because then no one will vote for me for president. And if the current president says, I'm not going to bail us out of this, the next president says, well, vote for me because I will. And then we all vote for that president. Mm-hmm. And that is why real estate tends to do well, regardless of what the economy is doing, regardless of if you made a bad decision with it, because inflation keeps happening because they just keep printing money. Now, if we know that real estate keeps doing well because of inflation, we also have to recognize that not investing your money is just as bad as investing in real estate is good. Mm-hmm. If you're not investing the money, inflation is eating it up and taking away its value. So it's a double-edged sword. You have to invest in real estate to not lose your money. And if you invest in real estate, you almost can't lose if you buy the right house and you can make your payment and you can hold it for a long enough period of time. So if you get those things right, you won't lose in real estate, and it's just how much am I going to make? That I don't think the same can be said of other asset classes, because if you buy a stock or you buy crypto or you buy bonds or you buy something that doesn't go up in value, that doesn't collect cash flow from your tenants, and the value of that asset drops temporarily, it doesn't come right back up like real estate will. And you can't hold it for the long term because you're not collecting income on it.
Right. That's true.
Do you have any follow-up questions there?
Well, then, as we're going into a so-called recession, this is the best time then to buy, to me. The best time to buy and maximize your growth returns. I'm in Houston, And so actually we're going out and I'm building a team because I am an agent and I also give out loans. And we're just trying to, create where people can just say, okay, we can build wealth. It's amazing how most agents, they don't believe in or have never experienced purchasing properties. And I'm a house hack my house because I'm single now and I have 3 other rooms I can rent out for like $1,200 a month, and I only pay 2. So,
well, I don't know that we are going into a recession. None of us know that. I'd say we're technically in one for one, right? But if are we going to come right back out of it? Well, if we keep printing money, we probably will. Are we going to go deeper into it? Well, if they keep raising rates, we probably will. And if they don't print money, we could probably go deeper into it. But if house prices go down because rates went up,
right,
wouldn't it be logical to assume that if rates go down, prices will go back up again?
That's logical.
Right? Now, is there any reason to think that rates won't go back down when the next politician wants to look good?
Oh, absolutely.
Right? That's what they're going to do. In fact, I'd even say the current administration, they got a lot of egg on their face because there's a ton of inflation. So they have to do something. So they raise the rate so that they get to tell us that they're doing something. And it does slow down the inflation growth. I think the last CPI numbers that came out looked much better than they were before. Do we think they're going to do this forever? They're just going to keep raising rates and no. As soon as they get to the point, this is just my opinion, I don't have a crystal ball, but I would say as soon as they get to a point where inflation is slowed down, they're like, okay, bring those rates right back down to where they were. And all of this talk of a recession and a depression and values crashing and what's Armageddon and all the world coming to an end, it disappears as fast as it came and people forget they were upset. Oh, rates are back down to mid fours. They're happening again, right? And then what happens with the value of real estate? Boom, it pops back up. The only thing making real estate come down in value is that they're raising rates.
Yeah.
Right? So if they keep rates where they are, I would say values are going to stay where they are or slowly tick back up. And if rates come down, the values of real estate are going to go back up. So my bet, Christian's bet, is that because they're raising rates, they're finally knocking out some of the competition that kept us from buying the best houses. So we're buying as many of them as we can, as long as they still cash flow, as long as we can get the numbers that work for what we're trying to do. We're buying houses. So, and the bet is rates will come back down at some point and we'll gain a lot of equity when that happens. So we don't know what's going to happen. And in my opinion, could change tomorrow if new information comes out. But as far as what we're seeing right now, I think that's a pretty safe bet. All right. Thank you for humoring us there. What was your question about the multifamily property you're trying to buy?
Well, I'm not trying to, but I got a call yesterday and I thought, no way in the world I'd buy that property. But it's in New York and it's like $70 million, 120 some odd units. So they're asking like $500 a door. And I'm thinking there's no way. But to get into a smaller unit like duplexes or even a larger one where you're not paying, you're paying $70 a door. How do you structure that to where you can make it a cash flowing cow, or do you just go into something like a mobile home park? A lot of doors that can create passive income.
Oh, we just lost Christian. I think I was going to let him answer that. Oh yeah. Christian, if you're there, do you want to take this on?
Oh my God. I'm talking when I was off screen now. I'm muted. I'm sorry.
Okay.
So question was the 70 million a door versus buying a smaller one. I'm sorry, repeat
right.
that one.
Or something that's not as expensive per door. I'm looking at like mobile home parks or something like maybe 400 doors where you're not paying but 70,000 a door, up to 100,000 a door.
Gotcha.
But, yeah.
Can I share? I won't say her name, David, but an agent on our team's recent experience buying cheaper properties because they thought it was safer. Can I share that story, David?
I'm not aware of that story. I really hope
we talked about it in Arizona, but I think my honest advice is:
are they selling these properties now because they didn't perform well, or is that a different?
I'm not sure.
Yeah,
okay.
they are.
I do.
That's what I'm talking about. So, in real estate, typically a cheaper sales price is viewed as safer. Fair. That's usually there's less out of pocket, there's less risk, your mortgage payment's lower, yada yada. But I would make the argument: does the AC unit to cool a $200,000 house cost different than the AC unit for the $500,000 house?
No.
Does the roof cost more or less? Does the flooring cost more or less? I can keep going, right?
Right.
There's a lot of fixed costs in real estate. And let's assume, you got a $100,000 house, and I'm not beating up any areas here, but in Kansas or in Memphis. And let's say you cash flow $200 a door, right? That would be viewed as a success, right? That's a successful purchase.
Exactly.
Now what happens when your $7,500 HVAC unit goes out? How many months of income does that decimate? $200 a month, what? 17 months?
Yeah, a
So
year and a half.
17 months of making income is completely wiped out. Now, I'll compare that to a higher value property that may cash flow, I'm thinking short-term rentals, $4,000 or $5,000 a month, which many of my properties do. And I got that AC unit covered in a month and a half.
True.
Right.
Okay.
So now I consider the risk factor and the capital cost so much more beneficial, even though I spent much more for that house. And obviously you have to have the conversation of, are you capable of buying? So I don't know if this person's capable of buying this $500,000 a door complex, but there could be, it's not always just cheaper is safer is really the concept that I wanted to get apart here. You really have to consider the fixed costs in real estate are exactly that. They're fixed, right? While your mortgage may be variable and your taxes and your insurance may be variable, I would never want to buy a unit where I have to cash flow for 2 years to pay for an HVAC. Like, I just wouldn't want it. It doesn't make sense to me, because an HVAC goes out you're a realtor, Angela. What, every 7 or 10 years your HVAC goes out?
Right.
So that means every 7 years, 2 years of income is eaten up with HVAC repairs. I don't want that.
That doesn't include the roof.
Makes sense. That makes a lot of sense.
Right?
Everybody likes what market, Angela, are you selling?
I'm in Houston.
Okay. Think about the city of Houston alone. Christian, don't lose your train of thought. I'm going to throw it back to you.
I'm here.
In Houston, when 2010 hit, were you living in that city at the time?
Yes.
All right. Were there neighborhoods that were decimated versus neighborhoods that were just kind of like they took a little bit of a dip?
Yes.
Yeah, it wasn't the whole city as a whole went down 20% or 30%, right?
Right.
The areas where the really wealthy oil executives were living with the best schools and the gated communities and the amenities that no one else had, they probably like slowed down a little bit, speed bump.
Right.
But the D-class neighborhoods got hammered. For still signs everywhere. Nobody wanted to touch them. You following me here?
Yes.
In that case, when prices went down, it was the cheaper priced homes that were
suffered the most.
Yes,
right.
Suffered the most. Now, if you were going to buy a cheaper priced home, my theory is you only do it at the bottom of a market. If you decide you want to get a D-class neighborhood, C- neighborhood, if the market's already bottomed, if it's 2010 and they can't really go down much more, you can buy there because you got nowhere to go but up. Okay? You think you're at the top of a market and a recession could be coming.
Oh, you don't.
The worst thing you could do is buy one of those cheaper homes because that's the one that's going to get hammered. Okay? So if you're timing the market, buying cheaper houses, worst thing you could do.
Okay.
And now Christian's saying, let's say that there are no market swings up and down. Let's say we just have a steady Eddie growth. In that case, buying cheaper homes is the worst thing you could do because your roof costs the same because it's the same square footage if the house costs 50 grand versus if it costs 5 million.
Right.
Right. But a $20,000 roof is 40% of the price of a $50,000 house. It is less than 1% of the house of the value of a more than $5 million house. Like, and that's literally what I was telling my agent when I was looking at homes today is like, it's a short-term rental. I'm going to have to call a person to come out here to spray for spiders at some point. The deck is going to need to be redone. I'm going to have to pay a guy $30 an hour of labor to come stain a deck. When the dishwasher goes out, I'm going to have to fix it. The fridge is going to go out. I can keep going on. In short-term rentals, things break all the time. If I bought a house for $2 million and I got to put a dishwasher that cost me $500 in that house, that could be a day's revenue on a $2 million house, or it could be less than a day's revenue. That could be 2 months of cash flow on the house that you're talking about. So now
Right.
not everyone can buy a $2 million house. I'm aware of that. But the point here is the goal is to get into more expensive real estate that generates bigger income, because your fixed cost will now be a smaller piece of the expenses. And that, I just wanted you to hear that and everyone else to hear that, because oftentimes people think, you know what, I want to buy a whole bunch of the cheapest houses that I can.
Right.
And
That's
then
the
it's
mindset.
yeah, it's the worst of both worlds to get into that. You'd be better off to get rid of all of those cheap houses and buy one nice one.
That sounds
Mhm.
familiar. Do you know somebody who just did that, David?
Yeah. I literally just sold 25 homes because every single month something was going wrong with one of them at all times. And it was like herding cats. It was very, very frustrating. And I sold them all and I bought about 10 really nice houses. And my cash flow went up, my equity went up, my revenue went up, and my headache went down. That's literally the goal that what you're trying to get to.
And this
Now,
is
on-
fun. So
on the-
imagine.
okay.
Oh, I'm sorry, Angela. Go for it.
No, I was asking, on the larger homes, are you holding and renting out? Are you buying and financing, owner financing, or what's your strategy if there's an exit at all? What's your strategy on making revenue on those homes? How are you doing that?
You want to start? Which homes are you talking about, Angela?
The larger homes, $2 million and up, or
Short-term
500
rentals.
short-term rentals. Okay.
Yeah, he's doing short-term rentals in a number of very highly traveled areas right now.
Okay.
So,
But you
places
have to,
we have
because if
comp-
you go try to buy a $2 million house and you try to make it hit the 1% rule or something like that as a long-term rental,
not gonna
right? Now it has to rent for 20 grand a month. And
Right. That's
yes, right.
Okay.
So I was forced to get into the short-term rental game because I wanted to buy in the best locations, the best amenities, because I don't know, the market could be going down more. It could, right? So if I think the market could be going down, but it also could be going up, I got risk on either side. I'm going to hedge that risk by buying the very best property. So if it goes down, I don't get hit that hard. And if it goes up, I stand to gain a lot. There's a name for this. I'm trying to think of what that is. Asymmetrical bets is what they call that, right?
Okay.
My loss is much smaller than what my win could be. But the only way I can pull that off is if these properties cash flow, and then I have to get into short-term rentals to make them do that.
Yeah.
Okay. That makes sense.
And a really nice factor here, David obviously had money to play with. So I don't want this to just be like blanket advice, but this is really good guidance for people who may have that money to invest. David has a couple properties in this purchase group that he's doing that overappraised. I want to draw attention to, if a $50,000 or $100,000 house overappraises, maybe it appraises for 105.
Mhm.
David had some properties that overappraised by $100,000, $200,000. So he's immediately going into a purchase realm where he has built in 5, 10, 20% equity. And like, that doesn't sound huge until you actually run the numbers. You're like, oh my God, you just stumbled into a $200,000 of new equity that you didn't have to contribute for on your down payment. And when you start considering like that, like, I'd rather have $1 million house overappraised by $100,000 than a $100,000 house overappraised by 10 grand. Right.
Right.
And obviously now that's equity that you may be able to go cash out from in the future and may appreciate more. So I think, once again, I'm not telling everybody to go buy $1 million houses, because not everybody has that capability. But if you're deciding between one $500,000 house and 5 $100,000 houses,
Mhm.
I think, in my personal experience, there's an obvious decision.
Yes. I do know that there's a lot of investors right now buying in California with the Exodus, right? And they're getting them at 500,000 and they're appraising at $1 million. It's like, okay, well, but it's an Exodus.
We haven't seen that. I don't know what area they're getting the houses at 500 that are
I know. Yeah. I can't remember.
I mean, there's a lot of people leaving California, but there's a lot of people moving into it also.
Yeah.
Okay.
I think it depends what city you're buying in when it comes to that. There's some cities where the population is decreasing faster than others, but you got to think about the fact that many areas in California had such a deficit of supply.
Yeah.
Like, this is something people haven't thought about. If every house in California is getting 10 offers, let's just say on average, every house is getting 10 offers for every listing. And let's say that half of your buyer pool leaves. Like, half of the buyers in a market say, I'm done, I'm not buying, I'm waiting, I'm moving somewhere else, whatever. You're
Mhm.
still getting 5 offers from every home,
Yeah.
right? And Angela, you're a realtor, you know, prices don't go down on homes if they're getting 5 offers. They just go up slower than if they were getting 10, and not that
And
much.
those 5 offers are probably, those are the 5 most qualified people who stayed, because the people leaving California, like, just in my experience, because we represent a lot of them on getting pre-approved for loans, it's not the tech executives super,
Okay.
affluent people leaving. Like, it's just consolidating the wealth in California to the people staying, right?
Right.
So it's kind of tricky. Like, one person leaving California is not equal to one staying. It's, you may be losing a $20,000 a year income person, but keeping a $500,000 a year, and like, that's not moving the housing market at all, right? So it's not, it's easy to draw conclusions from numbers like that, but really diving into, and I see the people we pre-approve in California, there's not a shortage of people looking to buy. I'll put it that way, right?
Okay, that's a good thing.
Yeah.
Yep. Thanks, Angela. I think
Thank
Houston's
you.
a solid market. I think Texas in general is growing.
Yeah.
Most places you buy, as long as it's a good neighborhood in that area, are going to do well. So I don't know Texas super well, but I've kind of had my eye in Corpus Christi for a while. I think that's one of those markets that has potential to become like the next big short-term rental market and buying.
Oh, yes. Also Brownsville, because SpaceX is going there.
There you go. I'd be looking at
Yeah.
areas like that. I'd find the biggest house I could that was the ugliest as possible. Find the agent with the terrible listing photos that took it at a 1% commission, so they're not motivated. It's been on the
75
market
days on market.
There you go. And go after that house.
The David
Okay.
Green special.
Okay. Thank you. And I hope to see you guys soon. Maybe
you,
come on
Angela.
down to Texas.
That's right.
All righty. Bye-bye.
Yeah, it's a good thing that real houses are not food, because if I shop for food the way I shop for houses, I'd be like, look at those brown bananas over there that have been sitting in here for 2 months. I'll give you 40 cents on the dollar for them, and I'd be negotiating with the grocery store there. I saw one today that I really liked. It's very high for this area. It was listed at almost 1.2. Really nice house though, on 3 acres, private drive going up to it. And they built a 4-car garage with a 2-bedroom unit above it. And the 4-car garage is massive and has a bathroom in it already. It is perfect to basically take that 4-car garage and that already has like 2 bedrooms, a family room, and a full kitchen and a bathroom above it, convert that into another like 3-bedroom property, and turn that whole structure into a 5-bedroom house with several bathrooms. Put a spa there. The main house has a spa with beautiful decks that already has like 4 or 5 bedrooms and a game room. And I could literally end up with 2 different 5-bedroom houses on the same property. And I have the agent calling the city tomorrow to see what the odds are that I could have it reparceled. And I could literally have 2 different houses in that situation, and just give myself an easement, since I own both of them, that they could drive through the one where the garage is to get to the other house. So guys, if you're worried about the market crashing and you're doing something like what I just described, do I care if the market goes down another 10% or another 20%, right? If I pay 1.2 and it goes down 20% and it drops to like 950, but I turned that into 2 houses, 2 5-bedroom houses, it's worth a whole lot more than the 950 that it could drop to. The problem with people that try to time the market is they're not looking at how to add value to the properties they're buying. They just want a turnkey house with no effort that also has a 25% ROI. And they're worried about, well, I can't find that easy deal that cash flows super hard and I don't have to do any work and I don't have to look for something that's been on the market for a long time. And if that's the way you're doing deals, you need the market to keep going up to make up for your lack of industriousness, to make up for the lack of good job you're doing. There's a ton of people that made money in real estate that are not good investors just because inflation lately has carried the market red hot. But if you're doing it the right way, if you're adding value, if you're looking for stuff, you're buying under market value, if you're buying in the best areas and the best properties in those areas, you don't fear the market going down. You're actually, like us, kind of excited about that. I couldn't have bought 15 houses that I would have wanted if the market was as hot as it was, because rates were still low. I wasn't going to get them my offer accepted. They were going to go with somebody else. So this is actually a good thing. Christian, anything you want to share about loan products before we get out of here? Because we were supposed to talk about that and we kind of got off topic.
I think we're good. I think we had a lot of good content today. I think we got some fun ones coming out, but I do think it's going to lead to more questions and answers. Maybe we'll just dedicate the next round of this to that. I think I'm going to leave people on a cliffhanger here.
All right.
If you want to know more, though, I'll post.
What's that, Christian?
At the One Brokerage. I just posted, I think I'm posting as you, but intake at theonebrokerage.com if you guys are interested in working with us. Obviously, we'd love to help.
Yep. If you have questions about our loan products, you can email us at questions@theonebrokerage.com. Theonebrokerage.com. If you know, I want to get approved for a loan, I want to buy a house with you guys, like some of the people that were on today, you go to intake@theonebrokerage.com. If you want to talk to Christian directly because you're shy, you can email him at christian@theonebrokerage.com. And if you'd like to meet Christian and I in person, we will be in Scottsdale in a couple weeks at the property that I bought with Rob. It's big, it's beautiful, it's dope, and it is going to be a life-changing event. So we are going to be meeting with other investors, bringing them in to meet each other. And I will be specifically teaching you on these deals that Christian just described that I bought, the loans that I used to get them, the way that I negotiated, what I look for to find a house that had a motivated seller. Once I was in contract, what I did to get even better pricing, how I ended up getting over 7 figures in equity over the last 15 houses that I have bought, and how you can do it too. I've never done an event like this. I've never shared this much of my own portfolio. We only have a couple spots left before the thing is completely sold out, and then you're going to have to wait for the next one. So if you'd like to learn how to do this at a very high level and be incredibly successful, go to davidgreen24.com/retreat. You can sign up for the event there and learn more about what we will be doing. It's going to be intense. It's going to be sitting around and having several sessions a day that are several hours long, where I am teaching you the fundamentals, the actual practical application of how to negotiate, what to look for, and then showing you, and here's the house I bought, and here's how those techniques worked on this specific case, so you can go replicate it. So go to davidgreen24.com/retreat. If you'd like to learn more about that, you can meet Christian and I in person. You can watch Christian shoot pool. He's not half bad. The house also is really fun. So there's going to be plenty of places where you can meet, network, mastermind with other people, learn more about what you talked about, kind of discuss it, and have a great time. So thank you guys for joining us here. I appreciate your attention. Thanks for spending your Friday night with us. For those of you that are on the East Coast, it's now 10:50 here. Thank you even more for being that committed to building your own wealth and getting ahead in life, that you're willing to be this committed to that. And Christian, thank you for joining me today and taking a break from the crazy work that you're out there doing to help our clients. Catch you guys on the next one.
Appreciate it, guys.